Welcome back to Credible Perspectives. This is episode 6 in the conversation surrounding taxation and tax matters in Kenya. We are joined in this episode by Mr. Robert Waruiru, who is a senior partner at Ichiban Tax and Business Advisory. He's also a respected voice in East Africa's tax policy and strategy space and has had years of experience advising businesses, governments, SMEs, etc. And so, karibu sana.
Thank you very much, Mukami.
Thank you for joining us.
Thank you.
We'll just go straight to the beginning. Where did this journey begin? When I say that, I don't mean when you were born. Kenyans can do things. Why tax? How did you get into the tax space?
Okay, that's a good question. So my journey begins from after high school. Mm-hmm. And my parents wanted me to do accounting. I wanted to do law. And in the gap year between high school and first year of university, I did some accounting. I liked it. I thought it was challenging. It was good. And then I went into law school, where I did my law degree. And then finished my law degree, did my pupillage, and then realized that actually I can combine accounting and law to focus on tax law. Now, we're talking about 22 or so years ago. There weren't too many people who had that combination of law and accounting. Mm-hmm. And so for me, the knack of numbers, the knack of reading the law came in naturally. And that's how I started doing tax. So I've done tax for about 22 years now. Okay.
And how has it been?
Well, the thing about tax is that it's very dynamic. Mm-hmm. You've got to read almost every day. You're reading because there are new things that are coming up. Like, for example, just last week, Wednesday, we had what I would call a defining decision of the High Court in terms of the VAT application of the VAT on payment service providers, PSPs, mm-hmm. which has been a big issue. And so for me, it's very, very interesting. It's dynamic. You got to read a lot. You meet different people. You meet different sector players. And so you get to interact with a lot of things, including investors, mm-hmm. and getting to hear their pain points.
Okay. So this year's East Africa Tax Summit is surrounding tax engagement, compliance, governance issues. And having worked in both, or rather having experienced and interacted with both government and businesses, let me use that for purposes of this conversation. What shifts are you seeing happening, and are they good ones or bad ones?
Okay. So there's definitely a shift in the sense that a lot more people are now aware of their tax obligations. Mm-hmm. People are a lot more switched on about what is happening from a tax perspective. And there's a lot of calls for accountability for the taxes that people are paying. So that's on the side of the citizen or the taxpayers. Government, on the other hand, is dealing with a much more enlightened citizenry, people who are asking questions, which I think is a really good thing. And you've got taxpayers who are questioning tax policy. Because, and especially for investors, they're saying, why do we have this policy? Why can't we, stick to the policy that we had previously? And so that conversation is, I think, a very good one in my view, because mm-hmm. it will then help us craft and define what the tax landscape is going to look like. Not just in Kenya, but across Africa globally, if you like. Now, one fundamental issue that we've always got to remember when it comes to tax is that there's an inherent push and pull, because as a taxpayer, I want to minimize the tax that I'm paying. Government, on the other hand, wants to enhance the amount of tax that they are collecting. So inevitably, there'll always be disputes. And so we've seen a lot of disputes coming around, not just in Kenya, even in Uganda, in Tanzania, across the region, mm-hmm. and even globally, as revenue authorities are pushing towards generating a lot more. And for a country like Kenya, if you look at Kenya, mm-hmm. Even when it comes to funding of our budget, there's a lot more focus on taxes, because we are nearing the debt ceiling. We cannot borrow much more. So certainly a good conversation to have. And I think this conference and this symposium couldn't have come at a better time.
Okay. Just before we started rolling the conversation around how the tax environment changes very abruptly and very many times in a year in Kenya. Having had worked for over 22 years, like you said, how have you seen this work out for us?
Yeah, that's a big challenge because you see, for business people and for investors at large, you want to have a very stable tax environment. Why? Because business is about planning. I invest this much. This is how these are the rules within which to play in terms of this investment, and this is the return that I expect from this investment. So then downstream or midstream, if there's a change, then as an investor, you're very upset because these changes may potentially impact your return and may make your business not even viable. And so for that reason, taxpayers they don't even want lower tax rates. Of course, we'll all be very happy with lower tax rates, but the number one requirement for investors is a stable tax regime. And actually, that's the reason why, if you look at the national tax policy, it says, our national tax policy that was adopted by Parliament in 2022, it says that we need to have our taxes or our tax provisions stay for 3 to 5 years so that we can have a look at the impact, the potential impact, or the impact that has arisen from these changes before we start changing. But in practice, what do we see? We are seeing changes, like you said, in this year alone, we've got 3 changes. And actually, a good example is the change for excess duty on transformers. That change came in on 27th of December 2024. Then in March 2025, it had already been reversed. So you're talking about 4 months. So you can imagine a player, and we do have people who assemble transformers in Kenya. So what are you telling them? What are you telling the industry? So that has been a big challenge, and I hope that as a country, we can stabilize that, the period within which we change our laws so that we can then support businesses.
Is it, you've mentioned the national tax policy. Does it say that we should change every 3 to 4 years, or is that the proposal of the taxpayer?
No, so actually, this is the government saying this is our policy, and our policy defines the actions from the executive perspective. So the executive is saying, from a tax perspective, we want to ensure that we've got a stable tax regime. So let's be changing our laws 3 to 5 years. It's actually in the policy.
So we're not following the policies. Where had no intention of heading in this direction, but now
you could say that there's a challenge in terms of sticking to the policy. Of course, we have seen some things in the policy that the government has executed, and a good example would be the shift in the taxation of pensions. It was very clear that the government wanted to move from exempting contributions, exempting the income of pensions, and exempting and taxing the income of pensioners. So we've moved from that and now into what we call exempt, meaning everything is exempt. Again, it was in the policy, it's been followed, it's been executed. Some of these proposals in the policy, I think, are a bit more touchy, like, for example, bringing down the VAT rate. That's a bit of a touchy thing, bringing down the PAYE rate for individuals. A bit touchy, but we hope that it's going to be implemented.
Okay. I don't plan to ask this question, but now that you've here and you've mentioned exempt maybe 4 times in your last sentence, what's the difference between exempt and zero rated?
That's a good question. And this is especially important for people who are in the VAT space. So when you look at VAT, it's got 3 categories of goods or supplies. So you can have standard rated, which is things that are subject to VAT at 16%. You have zero rated, which is subject to VAT at 0%. And then you have exempt, which is completely not subject to VAT. Now, when you make a supply which is zero rated, you're allowed to claim the costs that you have incurred from a VAT perspective. And I'll give you an example. So say, for example, somebody is manufacturing medicaments, and these medicaments are zero rated. It means when the manufacturer sells to the distributor, they will charge VAT at 0. But in manufacturing these medicaments, you've incurred electricity, for example, which has got VAT. You've incurred rent, which has got VAT. So as a manufacturer, you're allowed to claim the VAT on your rent, the VAT on your electricity, because you've made a zero-rated supply. However, if you make an exempt supply, you cannot claim that VAT for the rent, for the electricity, and so on, transportation. Which means because you cannot claim that VAT, you have to incorporate the VAT expense into the product price. That's the reason why you'll hear people saying that when you zero rate a product, it becomes slightly cheaper than when you exempt. And so for normal people, you'll say, well, zero rated exempt, there's no VAT. No, there's a slight difference in the sense that there are some costs that are hidden there that you cannot be able to claim if you're making exempt supplies. So that really is the distinction. Yeah.
Okay, let's go back to policy. A bit of policy. Unfortunately, you told me you're a lawyer, so we'll have this conversation a bit. But it's basically what we're having a discussion about, and how some of these decisions that are being made by our government, and especially not looking at it long term and making changes very rapidly, impact decision making in businesses. We spoke a bit about investors, but I want us to look at businesses and also the government. Does it benefit them in any way? Are we now as Kenyans trying to run away from complying with these laws and policies that are coming up? What have you seen in the various sectors?
So I don't think actually Kenyans are looking to run away from their obligations. In fact, it's the other way around.
Mm-hmm.
When you've got too many policy changes or too many changes within a very short period of time, then makes the entire compliance process very complex. Because then I really don't know, what is the current law, and unless you're a tax professional, even normal accountants may find it challenging to keep up with those changes. So that is one of the reasons why you will see, especially small businesses, saying, "Can we have a consistent policy environment so that we're able to comply?" That's number one.
Mm-hmm.
Number two, if it's too complex, it then becomes difficult to comply. So to your point around non-compliance, which is probably one of the experiences that we've had in Kenya, if you look at smaller businesses, they want to comply, but it's just too complex.
Yes.
And so this is the reason why you hear people saying, "Can you simplify it for us?"
Mm-hmm.
And you've seen Revenue Authority the other day talking about, if you only earn employment income, then you'll not even need to file your return. You just put in your ID number and the system has already auto-populated for you. To me, that's part of the simplification process, because once it's simple, then people will understand it, people will comply. Otherwise, we'll all just wait for Revenue Authority to come and try and audit us. And guess what? This government initiative of tax-based expansion will be a mirage, because nobody's willing to comply. It's just too difficult. So this is the reason why, especially for businesses, you're saying simplify the process, simplify the obligations. And part of these initiatives by government, again, an example of the e-teams, we spoke a bit earlier on about issuing e-teams invoices, is because government wants to collect this data and then pre-populate for you your return. Noble venture. However, in terms of implementation and rolling it out, it's been a big challenge.
How can that challenge be resolved?
So I guess there are several ways you can approach it, but one is stakeholder sensitization. Because you see, once people understand what you're trying to do, the policy imperatives or drivers behind your actions, then people are more prone to supporting you, to saying, "Okay, this is how we think you can support it. We can support you in this sector." You saw what happened in Murang'a with the avocado farmers. People just simply didn't understand what government was trying to do. However, what if government had gone to those farmers and said, "Okay, listen, everybody pays taxes in this country. We just want visibility of your operations. This is how you will compute the tax. This is how we can support you." I think you'd have probably gotten a better outcome. But also, Mukami, I think it's important to say here that for people to pay taxes, they need something in return. Government needs to show accountability for what they're collecting. Government needs to tell us what they're doing with these taxes. And so I think it's important that whichever administration is in place ensures that they apply those funds in a responsible manner, so that then, as a taxpayer, I don't feel the need to want to evade taxes. If you go to the West, of course, their tax rates are much higher, but also look at the services that their governments are offering. You don't pay for healthcare, you don't pay for education, you don't pay for your garbage to be collected, and so on and so forth. Why? Because you're paying taxes.
But apart from, there's the element of information which we'd spoken about earlier, and there's the idea of e-teams and how the government is doing a fantastic job with this tax base and expanding it. But are there other approaches that it can use? Or is it our responsibility as the taxpayers to be a bit more open or a bit more transparent in our taxes, in our earnings?
Yeah, so that's a good question. And let's start from here. So Kenya, prior to 1992, Kenya had an assessment regime. What I mean here is you give your earnings data to Revenue Authority, then somebody in Revenue Authority, in fact, that's why they are called assessing officers. They assess your tax liability. And then they tell you, "Hey, Mukami, we've looked at your data. You owe Kenya government 100,000 shillings and therefore pay this amount." So we moved from that. And in 1992, we adopted what is called a self-assessment regime, meaning you're the one with the data. You self-assess or tell us how much you think you owe us, and then pay that. And the self-assessment regime presupposes that you're going to be honest, right? Yeah, because I mean, after all, you're assessing yourself. And that's the reason why if you look at the tax law, there are penalties for willful failure to disclose, for example, your earnings. So that's the way it's structured in Kenya. Now, of course, maybe you'll not get everybody disclosing their full income, which is why we then go into what we call audits. Revenue Authority comes and audits and says, hey, Robert, we want to have a look at your affairs. Let's see whether you fully disclosed. Let's see whether you fully paid. And you then get an assessment and life goes on. So that's the way it was structured, and that's the way it's supposed to be. So to answer your question, the presumption is that you will be fully honest and you will disclose your incomes, you'll pay the taxes. And I have to say a majority of Kenyans are in that group. There are some who do not disclose, not because they don't want to, but because they don't know how to, which is the essence of the tax-based expansion. And I'll give you a very good example, rental income. If you've got a house which you are earning rental income, not many people know that you can pay 7.5% tax on that income, and that's the final tax. But what if government went out there and sensitized the population and said, actually, instead of paying tax at 30%, you can pay 7.5%. Many people will do that. Many people will pay that tax. So I think there's a bit that government also needs to do in terms of treasury, for that matter, in terms of sensitizing people.
Okay. You talked about evading, and we've also mentioned a bit about avoiding taxes. For purposes of Kenyans, what is the difference between tax evasion and tax avoidance? Are they illegal? Is it legal? What is that about?
Yeah, that's an interesting question, Mukami, because over time, the distinction seems to have faded away, especially from a Kenyan perspective. But to answer your question, evasion is illegal. Where you know that you have an obligation and you deliberately do not comply with that obligation and you don't pay. So that's evasion. Avoidance is where you structure your affairs in such a manner as to reduce your tax obligation. And there's absolutely nothing wrong with that. To the extent that you can look at the law, interpret the law and say, there's a gap which I can take advantage of here, then that is tax avoidance. And there's nothing wrong with that. However, the reason I'm saying that the distinction has sort of grown smaller as we've gone along is taxpayers, and especially, shall we say, experienced taxpayers and nuanced taxpayers who can afford high quality expertise, lawyers and accountants, they do what is called aggressive tax planning. So it's not illegal, but it is so aggressive that it almost looks illegal. And a good example of that is transfer pricing, which is the pricing between related companies across borders. So there's absolutely nothing illegal about that. But you can be so aggressive that you are not paying taxes in one country. And so revenue authorities, including Kenya Revenue Authority, we've seen a lot of that in Uganda as well. Uganda Revenue Authority going after taxpayers. Yeah.
You've brought in an element of cross-border transference of taxation. And with the African Continental Free Trade Area, AfCTA, gaining traction, what are some of the tax considerations that one should take into consideration while engaging in this cross-border trade?
Okay. So the AfCFTA, and that's a mouthful,
It is.
Yeah, so it's designed to encourage cross-border trade between African countries. And the last statistics that I remember seeing, that there's about 68 or 69 billion worth of $1 billion worth of trade that could be happening across amongst the African countries. But that could be a lot more without these tariff barriers. Now, when you say tariff barriers, it means, say, for example, something has been manufactured in Kenya, you want to export it into Uganda. How much tax do you pay for that product to get into Uganda? Now, the problem we have in Africa is that those taxes are so high that it's cheaper for somebody to import the same product from China than from Kenya. And so what AfCFTA tries to do is to remove those barriers, those we call them tariff barriers, to remove those taxes so that it then becomes easier. Now, once you do that, there's a big challenge for revenue authorities, because remember, these revenue authorities collect taxes from income tax. That's what you earn and what companies earn. They collect from VAT, and then they collect from customs. So if you reduce the customs revenues, then you're impacting the revenue that they collect.
Yes.
And that's the reason why you see a lot of them pushing back or pulling back and saying, no, we don't want to implement this AFCFTA. And that is a challenge. However, to your question, how do we see this working out? I hope that all the countries can get on board in terms of there's a schedule of how those rates are going to reduce as we go along. And I hope once we get to, I think it's 2028, that we have a majority of those ones coming to an end, the rates coming down. Once we get those rates down, we hope that there's going to be a lot more trade. Then what happens is that a lot more of that wealth is left in Kenya or within Africa. A lot more taxes can be paid from an income tax perspective. And hopefully, because of this cross-border trade, there can be a lot more investment, in the African continent, and therefore create more jobs. So it's sort of circular, but there's a lot of concern by revenue authorities because of the reduced customs duties.
Is there a way that can be expanded so that while on one end we're seeing somewhat reduced customs, but on the other hand, it encouraged. I think where I'm coming from is it an issue of volume versus smaller elements of tax? Am I making sense?
Yeah. I think it's not so much of an issue of volume because Africa has got the potential and it actually does produce a lot.
Yeah.
The bigger issue is tax, and therefore then the tariff barriers that are being imposed. Countries saying you cannot import into this country unless you pay this amount of duties. So that I think is where the challenge is. And so for African nations is about reducing those duties, enhancing trade, and ensuring that everybody is paying their taxes. Then you can collect a lot more taxes. So I think that really is the main concern.
Okay. Then let's look at global tax transparency and local implications. So I have to read out. How do emerging global tax transparency initiatives such as the OECD Pillar 2 on beneficial ownership disclosures affect East African businesses, and how should we prepare?
So a good example of this transparency is what Kenya has done. Actually, Kenya is the one which is leading the forefront in East Africa in terms of disclosures. And basically what it says is we want to know which companies are associated with Mukami and what transactions are happening between the company in Kenya and that company, say, for example, in Dubai or in Netherlands. So that's the whole idea about transparency. And if Mukami is the beneficial owner of the Kenyan company and the beneficial owner of the company in Netherlands, then can we understand how they are pricing their transactions so that we see at least they're not trying to shift profits from Kenya. This whole thing comes from shifting profits from one jurisdiction to another so that you can collect tax, because at the end of the day, all revenue authorities want to collect tax. So Kenyan Revenue Authority doesn't want you to shift profits from Kenya into Netherlands. And neither does Netherlands want you to shift from Netherlands to Kenya. So you're trying to bring that transparency. And so Kenya does actually have several initiatives that permit or allow KRA to see those kind of transactions. So for financial institutions, you've got what is called the common reporting standards. So banks, insurance companies, and the like will generally disclose to Revenue Authority, these are the transactions or these are the accounts. So for example, if you're an account holder in Switzerland, Switzerland Revenue Authority, what they call FTA, has already actually given Revenue Authority in Kenya a list of Kenyans with their accounts. And then KRA will come and ask you, okay, so Mukami, you can see you've got $100,000 in Switzerland. So what business do you run? And have you paid tax in Kenya on that? So that's the common reporting standards. And then now from a company perspective, there's something called country by country reporting, which is now where each country, where a company operates, say, in 14 different countries, reports the profits and the taxes that it has paid in those respective countries, country by country reporting. So Kenya is ahead of the curve in that respect. And this follows, one may ask, why is Kenya ahead of the curve?
Yeah.
When the OECD started, just to place context around this OECD discussion, OECD is Organization for Economic Cooperation and Development, which was a club of about 26 or 27 largely European countries. So they came together after the global financial crisis in 2008, and they said, hey, we think people are aggressively tax planning. Can we come up with initiatives to avoid that? And one of the initiatives that came up from that is base erosion and profit shifting, which is transfer pricing. Then in 2015, they realized actually, we can't just pick only the 27 countries, OECD member countries.
Yeah.
We need to open it up to the rest of the world. And in 2016, they opened it up to the rest of the world. And whatever came out of that is what is called now the inclusive framework, IF. So the inclusive framework has got non-OECD member countries. The reason why Kenya is ahead is because Kenya was amongst the first countries to join the inclusive framework. So has been at the table for a much, much longer time, and therefore is leading in terms of some of these solutions about transparency.
Okay. So does that mean that we can't hide our money in other jurisdictions? I was really trying to avoid, because, well, yeah, just answer that one first.
Oh, why do you want to hide your money? Pay your taxes and...
Me as Mokami, I'm fine keeping my money in Kenya. I don't have a problem. But there are some people in this Kenya who don't want to keep all the money in Kenya. They want to spread their risks.
And there's absolutely nothing wrong with spreading the risk like that. And the question that KRA will normally ask, or any revenue authority will ask is, has this money come from income that has been taxed? And to the extent that it's been taxed, then absolutely no problem. And I agree with you in terms of risk management and diversification. It doesn't make sense to have all your investments in Kenya.
Yeah.
The challenge comes in where you've got proceeds that have not been subjected to tax, and then now you want to take that out of the country. So most revenue authorities will frown upon that, and that's actually what this base erosion and profit shifting, tax transparency is all about. Just ensuring that people will pay their taxes.
Okay.
Yeah.
Let's switch gears a bit and go into tax disputes and how that is being managed in Kenya. Apart from the tax planning that you've mentioned, what other measures can businesses take to avoid getting into a place of non-compliance, which ends up in tax disputes in the country?
Okay. So the easiest, I think, would be compliance. Just comply with your tax obligations. If you need to file a tax return by 20th of the following month, file your tax return. If you need to pay withholding tax when you pay a professional, again, just pay it. That's the number one defense in terms of avoiding disputes, because then once you're compliant, then revenue authority has no business coming to audit you. Yeah. However, like we've said, because of the complexities of the tax law, because of the various changes that come in, once in a while you may not be compliant, and that will then result into a review by revenue authority or an audit, which then crystallizes a dispute. My experience with dispute resolution, and there are very many disputes, by the way, right now, especially from a customs perspective. My experience with dispute resolution is try and have a conversation with the assessing team to agree on the facts, because we've seen a lot of disputes going to the court and the tax appeals tribunal, and the tribunals and courts saying, you did not present these facts to the commissioner. And so the commissioner is right in holding his or her position. So clarifying those facts before even the dispute crystallizes is so important. And then to the extent that there's a liability, by all means, negotiate a payment plan. Everybody understands that we're operating in a very tight fiscal space. So this cash flow is a problem. So negotiate with revenue authority, ask for a payment plan, and you'll be surprised. You might ask for a payment plan for 12 months and the commissioner agrees, because your business can only afford to pay in 12 installments. So those would be my thoughts around dispute resolution, but there are a lot of disputes.
Yeah, I want us to dig a bit into that. You've specifically mentioned disputes in customs. What kind of disputes are you seeing? And not limited to customs, though.
Yeah. So the key disputes around customs are in terms of valuation, valuation and tariff codes. Now, what do I mean? When you import, say, the seat that I'm sitting on, somebody could say, this is for a restaurant, or this is an office chair. So depending on how it's, or let's say, orthopedic chair, is it a medical device or not? So one of the things that we've seen with revenue authority saying is revenue authority saying, no, this is furniture, and therefore we want to collect excess duty at 45%. Then the taxpayer says, no, actually, this is a medical equipment because my doctor has recommended that I sit on a yellow seat, which looks like this and that kind of a thing. So I should be paying tax at 0%. You see, you have a dispute about the classification of the asset and therefore whether the duty is going to be payable or not. One thing that I have seen with customs is And a lot of people ask, why is it that customs is performing at 107? Last year they did 107% of their target. It's because of the aggression that they have in terms of this customs audits. So customs is really, really a big one. And then we have issues around valuation. I've imported this vehicle, and you saw it with the motor vehicle importers. I've imported this vehicle. It's valued at $5,000. KRA comes and says, no, it's actually $7,000. Why? Because the duty is based on the value that has been disclosed. So the higher the value, then the higher the duty that is payable. So that's from a customs perspective. We've also seen a lot of developments in, the problem with law is that it always lags behind technology. So if you remember, I told you about the payment service providers, which today, payment service providers, I don't even know what we would do without them. The PesaPals, the Ken switches, and those kind of guys. What would you do without them from a convenience perspective? So the service that they're offering, the industry says, this is how we are viewing the service, and therefore this is how we treat it for tax purposes. KRA says, no, we disagree with you because the law did not envisage that. And so we have a scenario where the law is way behind technology and then therefore crystallizing these disputes. Then you've got your normal disputes around income tax, expenses, and so on. But those ones are few and far between. I think the biggest issues today are to do with technology growth or development and the slow pace at which revenue law is responding to these changes.
You've mentioned about technology, and one of the big conversations right now is on virtual assets. How can we comply with tax on virtual assets, considering we still don't have laws on that? Is it practical? Are we biting more than we can chew? What do you think about that?
And that actually highlights the challenge that we have with law. It's so far behind some of these developments. Virtual assets. Everybody's talking about NFTs, digital currencies, and so on. But look at our law. It's not designed to think about it. No, in fact, you've even gone far. Think about digital commerce.
Yes.
Our law had not envisaged that I can sit here and order lunch while seated here on an online platform. Kenya has moved a bit and has tried to tax what is now called the digital services tax, which, as you've seen, the US, Trump is breathing fire around that and saying, these unilateral measures, we disagree with them and we're going to impose retaliatory measures. So this is a challenge. But to answer your question around virtual assets, we had tried to tax them in 2023. But last year, this Finance Act 2025, the KRA has said, let's go back to the drawing board. The policymakers have said, let's go back to the drawing board. Let's see how we're going to tax it. And I agree with that because some of those challenges that are presented by those assets is a big problem. You can't tax me on the transaction value. What if I don't make a gain? Yeah.
Okay. Looking forward, if you could implement one major tax policy, I go back to policy, change today to boost the economy, to boost, to encourage, the expansion of the tax base, which you've mentioned, what would it be?
For me, it would be reduction in tax rates. Yes.
Okay.
Because you see, Mokami,
we will be followed for that response, my friend.
No, listen. If today you're going to be paying tax at 35%. What if you paid tax at 25%? It means this additional 10%, you're going to spend it. Maybe you're going to be, instead of going to the salon once every 2 weeks, you're going to be going to the salon once every week. You're going to be getting your car washed every day, probably. And you're going to invest and so on and so forth. So you're going to create demand, which is then going to pay VAT. So for me, I look forward to the day that we can reduce tax rates, because I think as a country, we are taxed quite a fair amount. So that would be the policy change that I'd move for.
I think this is a good place to end this episode at. Thank you so much for honoring our invite. It's been a very interesting conversation. You've left us with a bit of food for thought on reducing tax rates. And we hope to see you at the East Africa Tax Summit.
Absolutely. Looking forward to that.
Fantastic. And thank you so much once again for joining us in this episode. See you in the next one.